We got a hotter than expected inflation report just by a little bit, but the market was not totally breaking down. So I think many people very early in the day continued the bullish notions that we've seen all year, virtually it seems, and continued to just buy stocks with cash, with margin, however it's continuing to be done, and expecting more fruits to occur. Coincidentally or ironically, I happen to think if inflation came in cooler than expected by 1/10, that, or CPI in particular, that the market would be screaming higher. So for it to be screaming higher, if it came in the less desirable outcome, or at least up, quite interesting. Ultimately, inflation does seem to be cooling. It looks like it has ended its continuous rate of massive increases at a very, very intense clip. But it is very volatile. We are definitely seeing volatile inflation. This is not what the Fed is trying to get. The Fed is not trying to get, they had a 0.2% month-on-month read here. We're there. That's it. That's zero inflation, as we heard at one point last year. They want calm. They want a long period of time of inflation at 2% to be convinced that they have, maybe finally gotten it to cool, gotten price stability. So the idea that we're still having 0.6, 0.4 numbers, it's not their ideal outcome. However, I think, gasoline prices have pulled back a lot here. It's probably not going to be so bad for the month of October, but I do think there's going to be a squeeze on gasoline once gas stations begin to refill again and they feel that gas prices have bottomed and it is a good opportunity to buy. This is based on stuff I'm hearing from the Gas Buddy guy and other things I'm looking at. So I think things are volatile. I don't think we're at 2% yet. And that is one side of the equation. So obviously higher for longer, the things we've been talking about all year with regards to that. But while everything was green, even though we got hotter than expected inflation, there was a reversal at one point in the market. And this was a big reversal. Whoa, what was this? Potentially caught some people off guard. What happened was that there was a 30-year bond auction. So the United States Treasury auctions bonds, and people can go on Treasury Direct, buy bonds. Lots of hedge funds, foreign investment funds, foreign entities, and U.S. domestic entities participate in these auctions and bid on these auctions. At the time the 30-year was issued, I believe it was 4.8% flat, but the auction went for 4.837%, which was the largest spread, also known as a tail, since November 2021, which, if you remember, was the time. That was the peak of the QQQ, peak of the NASDAQ, peak of the tech, when the Fed shifted from, we're not even talking about raising rates, to we're now talking about raising rates. Okay, it's been a very slow process. Started very slow for the Fed, but they finally did start to catch up to what needed to happen after all the money printing and the record low interest rates. And so we're seeing market conditions that are relatively hesitant, that are on shaky grounds. This is not good near term. If you look at this one thing in isolation, you can be concerned. And I am concerned. I am concerned about Treasury demand. As a holistic view, I'm somewhat concerned about that. However, I think ultimately we're going to find equilibrium. What do I mean by this? How are we going to find equilibrium? Well, as interest rates rise, there will be a point where, all else equal, more buyers come in, There's a supply and demand curve for every single good and service in the world, and that includes assets. And as the price falls, aka yields rise, you entice potential investors a little bit more. There will be some who participate more so in the auctions and decide to buy closer to the when issued price. However, that's not the only thing that matters here. as rates rise, financial conditions tighten. Less people want to borrow. So there's less demand for new loans. The economy begins to slow. Financial conditions tighten. The economy begins to slow. Economic growth slows. As economic growth slows, people buy bonds. That's what happens. So this scary notion we're seeing today does not mean that all hell has broken loose and we're in some sort of catastrophe here. There will be equilibrium in this market. It will occur. Do rates have to rise a little bit higher? It's certainly possible because indications are that the economy isn't breaking down in any meaningful way. It's definitely slowing. I definitely expect it to slow, but I myself have been surprised, and this was a little bit of my own ignorance, that we could actually get more economic slowdown just because the nominal rate changed. We were so deeply in negative real rates that we just in the last few months, maybe it's been the last 5 months, I don't know exactly when, got the interest rates to equal the inflation rate, aka a real interest rate of 0. So that is, money is free in real terms. And now money is finally starting to cost something, which it always should, because there are risks associated with lending. Besides default risk, there's currency risk, there's duration risk, there's opportunity cost, there's all these risks. So money shouldn't be free, but it was. We're getting closer and closer to this equilibrium. Obviously, we have some issues with China. We have some issues with Japan. We have some issues with Saudi Arabia. Beyond the geopolitical tensions, we have their currencies weakening relative to the dollar, of which is the world's reserve currency, and many commodities are traded based on. And these countries need to sell their dollars and their dollar-denominated assets and essentially short the dollar and buy their own currency to strengthen it. So, there's some weak forces. There's some bad forces. I'm not saying it's all good, but I'm also saying this yield picture is not a big calamity. So, overall, I am not so optimistic about the market. I think we haven't really repriced for these higher interest rates. These are higher interest rates than we've seen in over a decade. So to use multiples well above the last decade plus averages, as we said, higher rates will lead to tightening financial conditions. Tightening financial conditions will lead to economic growth slowing. Like, that is an important part of the equation. There's a lot of things here at play to be well above. Particularly, like, we're well above, like, the last 5 and 10 year average multiples, but COVID totally destroyed the data. So you have that average multiple being higher because of COVID, because earnings expectations came down so much. Earnings for some companies also came down for a little bit, however you want to quantify it, and prices went up a lot, so the multiples went up, so it skewed the whole data. So there's a lot of things that I'm looking at. Additionally, QT, first time ever, that lead me to not be optimistic on the stock market. Unfortunately, I would love to just be long stocks. It's a lot more fun that way. So I have to keep my selection pretty narrow and pretty tight to things that I think are well priced and produce cash. And pay me that cash as the dollar continues to strengthen, like energy. That's why I like energy so much. It's not that I love oil and I'm like this huge oil buff and I think, oil's my passion and oil till I die. That's not why. Why I like oil is because it has fundamental strength and very good asset pricing at a time when most of the rest of the market is not that way. That's why I like it. Pretty simple to me. So, that's today's video, and until next time, peace out. Please like and subscribe. And if you have any questions, consider me your free financial advisor until you have a net worth of $2.1 million plus, excluding your primary residence, and then you can join the fund, which I encourage and is better than just getting free advice. So, that's today's video. And until next time, peace out.